We're going to stay in the region broadly because it's when things look their worst that value investors step in. And they couldn't get much worse for Japan. Certainly, we are looking at the after effects of the March 11 quake and tsunami that has taken the Nikkei solidly to the downside. In fact, since that peak in 1990, we've backed off 75%. Remember, this is the indice of the world's second largest economy. Lorne Steinberg joins us now, president of Lorne Steinberg Wealth Management, and he is one of those value investors who might see the cheapness inside some of the gloom. Lorne, good to have you on the program.
Martin, thanks so much for having me here. It's great to be back.
I'm glad that you're back. We've wanted to speak to you for a number of weeks now because you and I had a very interesting conversation prior to Christmas about value in Japan equities.
Absolutely.
The story remains the same, I should imagine, but the macro backdrop is really disconcerting.
It's disconcerting from people watching the media and all of the pictures going on and all the rest of that. But in fact, I look at this situation as really this could be the inflection point that really drives Japan forward and brings investor interest back to this country. In fact, amazingly, the stocks that we've been buying have been so cheap that here we have a horrendous disaster, and the Nikkei has only fallen about 7% since the earthquake. And in fact, when we look at a lot of the stocks that we own, a lot of them have actually risen since the earthquake. And we're starting to see all kinds of funds and investors taking a hard look at Japan and seeing some of the amazing values that exist. Also, of course, Japan, the big negatives that everybody knows about are highest debt to GDP of the G8, most aged population in the world, in fact, starting to decline, and virtually no immigration. But the Japanese government was not standing still, and even before the earthquake, the government was already addressing some of these situations. Huge tax reform package and acknowledgement that Japan has to open itself up to foreign investment. And so Japan actually passed a tax reform package which gives a break to foreign companies coming into Japan and investing in Japan and hiring Japanese workers, which is going to start to bring in some immigration. And the population gets it. They understand. Since the earthquake, everybody's now coalescing around this concept that we have to drive forward quickly. We speak to people in Japan on a daily basis. You read the press in Japan on a daily basis. And the media, the population, the politicians, everybody is behind this concept that it's time to change. Second of all, from everything bad often comes something good. Japan has been a zero growth situation for the last 20 years, really flatlining. The big rebuild that's going to go on is going to drive some GDP growth in the short term over the next couple of years. And it's going to give Japan a really huge boost. The savings rate has always been high, and it remains high. And the advantage Japan has versus so many indebted countries is that unlike the European countries like Greece and Ireland, Japan doesn't need any foreigners to hold its debt. And so 10-year bonds in Japan yield a little over 1%. They're borrowing money for almost nothing. The Japanese, the growth that's going to come about is going to help them address the deficit. We are going to see, I think, a sea change in the view towards immigration in Japan as foreign companies start to come in there. And with all of these ridiculously cheap values there, we're starting to see some of the big buyout firms like KKR take an interest in Japan. And the Japanese government is open to foreign takeovers, and we've started to see some M&A activity.
Well, let's get into some of the names, because I'm going to make the assumption that as a value investor, you're going to advocate a strategy of name selection rather than passive indice investment.
Absolutely.
Yeah. So we're going to get into one right now. Really cool area, medical devices. We talk about it a lot in Europe and a lot in North America, less so in Asia Pacific, but Kawasumi Laboratories. I don't know if I'm pronouncing that right.
Kawasumi Labs is a great company that specializes, in single-use items and disposable items, so stuff that gets consumed all the time. Huge beneficiary of Japan's aging population, everything from catheters to feeding tubes and the like. But the valuation is incredibly compelling.
So here's a stock that you would snap up in a second if it was in North America. No debt, cheap valuation, and you're getting it cheaper than book value with a dividend.
Not only cheaper than book value, we're buying it cheaper for than the short-term assets.
It's astonishing.
We're buying $1 of cash and short-term assets for about 70 cents. An incredibly cheap PE ratio. We're getting the whole business for free.
Yeah.
A double-digit grower, 8 times earnings, 2.7% dividend yield.
It's astonishing.
It's amazing.
Yeah. JMS would be another one that would offer the similar characteristics.
Absolutely. In fact, JMS is a very similar company, slightly different product line, but again, disposable items, masks and catheters and IV tubes. 9 times earnings, trading for half of tangible book value.
That's the short-term assets that you referred to.
Exactly.
Yeah.
And you're getting a 2.6% dividend. I mean, these stocks should be double or triple their price.
Yeah.
But they're completely and have an off-the-radar screen of global investors for such a long time.
That's really interesting. The other one that had a really compelling valuation proposition, Yodogawa Steel, worried me a little bit more so in the space that it was in the steel sector with so much global competition.
Right, except Yodogawa is a company that will be a huge beneficiary of the rebuild.
Yeah.
Of the rebuild.
There'll be some bias to domestic firms, presumably.
Yodogawa is actually an exporter as well, but there may be nothing left for them to export because all of their steel is probably going to go into the rebuild. Again, all of these companies, another great company with zero debt, trading for less than half of tangible book value. So you're getting $1's worth of short-term assets in cash for less than $1. You get a great steel company trading an amazing valuation and a dividend yield of almost 3%. While you're waiting, I mean, Yodogawa's earnings could easily double in the next 2 to 3 years.
That's fantastic. And another name, a bit more familiar, Yamaha. Not the motorbikes.
Not the motorbikes. Anybody with kids studying music might be familiar with Yamaha pianos and keyboards and the whole thing. So this is truly a global company with a great, compelling market leadership and a global brand to begin with. And again, like so many Japanese companies, zero debt, trading for less than tangible book value. They're coming off a bad year, so their trailing price earnings ratio is over 20. But, we look forward at Yamaha's earnings next couple of years, and we expect their earnings to be rebounding in a huge way and, probably trading for 10 to 12 times earnings going out 2 to 3 years, a dividend yield while you wait, and trading below breakup value. The funny thing is the Japanese bond market is extremely tiny, the corporate bond market, because very few companies have debt.
Yes.
So the amazing thing is companies have this long-term time horizon, and they save their money because, what if the worst case happens?
Yeah.
And these guys are all in spectacular shape, trading at valuations that make no sense.
Let's check it out. 4 names for you to look at in there. Lorne, we'll get you back a little bit later in the summer. We'll test the hypothesis and maybe get a couple more if we can.
Martin, thank you very much again for having me here. It's such a great
Always enjoy it, Lorne. Thanks very much indeed. Lorne Steinberg joining us just there. He is with Lorne Steinberg Wealth Management, the president, in point of fact, of that firm. Some good ideas in there.